Hi everyone, today let's take a look at Fundrise. Do me a quick favor and like and subscribe and watch the video till the end to help out the channel, and let's get started. So it's been a while since we've looked at Fundrise, but they did publish an article here this month, and you can see as we got our first rate cuts, they are starting to see a rise in valuation. The flagship fund is doing pretty good, up nearly 6% on the year, which is better than it had been doing for sure. They definitely struggled. It's not doing super great relative to everything else. We are seeing the stock market do very, very well, but finally real estate is starting to do better with that first 50 basis point cut, which of course we expect to continue to happen over the next 24 months, which is a bullish environment for real estate. And that's really what they're saying here. Impacts of rate cuts on real estate and private credit. And on the back of those, you can see good returns so far this year. It's a little bit annoying to see the income fund doing better than the flagship fund. Flagship is supposed to have more equity in real estate. It seems like the dividend fund here continues to do a little bit better. But really what they believe is that real estate values have largely bottomed. We're going to see that continued rate cutting cycle and easing of monetary policy like we did through the first 3 quarters, and really that should accelerate as we continue to get these falling interest rates being a primary driver for this potential bull market in real estate. They say the higher rates did cause a slowing of construction, which usually takes a few years to impact the market. They're going to see less competition as it takes time for the building market to catch up to demand, which they say is growing at a faster pace than they predicted. So demand is going higher, significantly higher migration, demand for homes being more competitive, but the construction is going to take a while to catch up. Not sure exactly how true that is. I know new home sales and new construction has kept up fairly well, but these lagging impacts of higher interest rates can be felt for many years. So that's a potential driver of valuations in real estate over the next coming years. And they said they expect this window to be open for 12 to 24 months, especially for private credit, which they say has been unusually strong, which speaks back to what I was just saying. They've been doing quite well in that sector. And ideally, buying the real estate itself should do better over the medium term, dividends plus owning the asset. And then lastly here, they do reference their innovation fund, which is their venture capital fund, continuing to invest in 5 of the 6 top companies on CNBC's top 50 disruptor list, to include Cloud, OpenAI, Anthropic, Databricks, Canva, and Anduril. And overall, they just expect the fundamentals within real estate to continue to stay strong as we continue to see this rate cutting cycle. And then you can see the returns across the board: flagship fund, income fund, innovation fund. Not doing super great in the short term, but is expected to do well over the medium term. Not everything is rosy though. You can see REIT 2 still slightly negative, development REIT still slightly negative, but growth REITs pretty good, 6.7. East Coast REIT not doing super great, but the balanced REIT pretty good there, 7.8%. In general, it looks pretty good and better than it had been doing over the last year or two. Moving over to my accounts, you can see it's worth just less than $68,000 now, which is not terrible, but net returns is nearly $7,000. But this is over a long period of time. I started investing all the way back here in 2019, so about 5 years ago. And honestly, I thought the returns would be a little bit better over that time period. You can see the annualized on real estate is 3.5%, venture capital 3.3% here, and then private credit 7.9% annualized. That's been the best performer. This is where I've really been investing the most money recently. And they did really well in 23, really well in 24, versus real estate down 10.5% in 2023. But now we're starting to see this kind of rally here in real estate this year. Hopefully that continues like they said that it will. Again, not everything is positive. Growth REIT 2, East Coast REIT, again, not huge positions for me. Development REIT has done terrible. The annualized is negative there. Over the last 3 years, not doing super well. So again, it is making money, but you do have to consider opportunity risk. Is there a better place to make money? Probably for now. I do want to see how this most recent cycle plays out though. As rates get cut, we should see valuations go up in the real estate fund. I want to see them capture those gains. Otherwise, I might start to move this money somewhere else. Let me know down in the comments section what you think of Fundrise. Where would you be putting money if you're trying to get into real estate? Is it with Fundrise, or are you buying public REITs or one of their competitors like Roots? Otherwise, like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.